You wake up on a Tuesday morning, and for the first time in years, you actually feel good about money. Not rich, not lucky, just right. You did everything the way you were supposed to. You bought silver back in 2022 when everyone said it was a hedge. You held it. You watched it climb. And then, when the moment felt perfect, you sold. $43,000 landed in your bank account on a Thursday afternoon, and you sat there staring at that number on your phone screen thinking, finally, something worked. You didn't gamble. You didn't speculate wildly. You made a calculated, patient decision, and it paid off. You took your wife out to dinner that Friday. Nothing crazy, just a nice place you'd been putting off for 2 years. You talked about the bathroom renovation you kept delaying. You talked about maybe, just maybe, taking that trip to Portugal you'd been bookmarking since 2019. For the first time in a long time, the future felt like something you were moving toward instead of something happening to you. Then Monday came. You open your banking app to transfer money for the contractor you'd already scheduled, and the screen doesn't load the way it usually does. There's a message, not a notification. A message. Your account has been temporarily restricted pending review. No dollar amount, no timeline, no explanation. Just a phone number and a case number that when you call it, puts you on hold for 47 minutes before someone reads you a script that tells you absolutely nothing. You're not panicking yet. You figure it's a mistake. These things happen. Banks make errors. You're a customer in good standing. You've had this account for 11 years. But then Wednesday arrives and there's a letter in your physical mailbox. Not an email. A letter. From the IRS. It's not an audit notice, not yet. It's what they call a soft inquiry, a request for documentation related to a deposit made on a specific date. Your date, your deposit, $43,000. You think, okay, fine, I'll just send them the records. I have records, I kept everything. And then Friday, 5 days after the account freeze, a second letter arrives. This one is from the Social Security Administration. It's about your estimated benefit recalculation, because a transaction of that size, depending on how it gets classified, can affect your reported income for the year. And your reported income for the year affects projections that were already locked into your retirement timeline. You are not a criminal. You never hid anything. You never moved money offshore. You never tried to cheat the system. You are a 54-year-old person who sold a legal asset at a legal profit and deposited the money into your own bank account. And in the span of 8 days, your account is frozen, the federal government is asking questions, and your retirement math just got complicated. Here's what nobody told you. And I mean nobody. Not your bank. Not the financial media. Not the guy on YouTube who told you silver was going to save your portfolio. There is a layer of financial infrastructure operating in this country and across the Western world right now that most people have no idea exists. It's not a conspiracy. It's not shadowy elites in a room somewhere. It is automated, algorithmic, and completely indifferent to your intentions. It doesn't care that you're honest. It doesn't care that you saved for years. It doesn't care that you were just trying to protect what you worked for. It sees a number. It sees a pattern. It flags it. And then a process begins that you are completely unprepared for, because nobody ever explained to you that it existed. And here's the thing that should keep you up at night. The rules that triggered all of this? They didn't make headlines. There was no press conference, no alert from your bank, no email from your financial advisor. The thresholds changed. The reporting requirements changed. The way AI systems inside banks classify transactions, that changed too. And the people most exposed to these changes are not the wealthy, who have lawyers and accountants watching every regulatory update. The people most exposed are exactly who you are. Middle income, financially conscious, trying to do the right thing, working with information that is already 6 months out of date. That man who sold his silver and watched his life get complicated in 8 days. He didn't make a moral mistake. He made an informational one. He didn't know about one rule, one threshold, one automated trigger that went live without anyone sending him a memo. Right now, I'm going to explain exactly how this works. And by the time I'm done, you're going to understand not just what happened to him, but why, statistically, it could happen to you. Not because you're careless, because the system was redesigned while you weren't looking, and the people who benefit from your confusion have absolutely no reason to explain it to you. So stay with me, because what comes next is the part they really don't want you to hear. If you find this kind of financial history useful, please consider subscribing. It really supports the channel and helps me keep making these videos. And write your city or country in the comments. I'm genuinely curious to see where everyone is watching from and how this story connects people from different parts of the world. Let me be honest with you about something. The financial system you grew up trusting, the one that told you to save, invest smart, pay your taxes, and everything will be fine, that system has been quietly, methodically rewired. Not overnight, not with a dramatic announcement, piece by piece, regulation by regulation, algorithm by algorithm, until the version of the system that exists today in 2026 looks almost nothing like the one you thought you understood. And the most dangerous part? It still uses the same words, the same logos, the same reassuring language, but underneath, the machinery is completely different. Here's a number that should stop you cold. 398 million. That is the number of personal data records that leaked in Russia in January of 2026, in a single month. Banking records, government files, online platform data, 398 million individual profiles exposed, compromised, or sold. Now you might be thinking, that's Russia, that's not my problem. And that's exactly the kind of thinking that leaves you vulnerable. Because what that number tells you is not just about Russia. It tells you about the architecture of modern financial surveillance. It tells you that governments, banks, and digital platforms are sitting on oceans of data about you, your transaction history, your income patterns, your asset movements, your spending behavior. And that data is being processed, cross-referenced, and acted upon in real time every single day. Whether you live in Moscow or Minneapolis or Munich, you are not anonymous in the financial system. You never were. But in 2026, you are less anonymous than at any other point in human history. And the systems watching you are no longer run by humans who might use judgment or context or common sense. They are run by artificial intelligence. And AI does not do nuance. AI does pattern recognition. And the pattern it's been trained to flag looks a lot like a regular person making a smart financial move at the wrong moment. Think about what that actually means in practice. You sell a substantial asset, crypto, silver, real estate equity, a business stake, it doesn't matter what. The money hits your account. Within seconds, not days, not hours, seconds, an automated system inside your bank has already run that deposit through a risk-scoring model. It has compared the amount against your historical average. It has noted the source. It has checked whether the timing aligns with known patterns for what the compliance industry calls structuring, layering, or unusual asset liquidation. And if any combination of those variables crosses a threshold you were never told about, a threshold that may have been recalibrated last quarter without a single public announcement, a flag goes up. Not because a human being looked at your file and decided you're suspicious, because a machine decided your numbers don't match its model of normal. And here's the part that makes this genuinely terrifying. Banks in 2026 are legally required to run these systems. It's not optional. It's not a policy choice. Under international anti-money laundering frameworks that have expanded dramatically since 2023, financial institutions that fail to flag unusual transactions face massive regulatory penalties. So your bank is not flagging you because they think you're a criminal. They're flagging you because the algorithm said so, and ignoring the algorithm would cost them more than ignoring you. This is the invisible machinery. This is the system no one explains at the new account sign-up, and it operates on 3 layers that most people have never even heard of. The first layer is the reporting threshold, and it is not what you think it is. Most people have heard of $10,000. They think that's the magic number. Stay under 10,000. Stay invisible. That belief is not just outdated. It is actively dangerous. Because in 2026, the threshold is not a single dollar figure. It's a behavioral model, multiple transactions across different time windows, the ratio of inflows to outflows, whether your account received a large transfer after a period of low activity. These variables are combined into a risk score, and your risk score determines whether you get flagged, not just one number. The second layer is cross-institutional data sharing. Banks, the IRS, payment platforms, and in some cases, cryptocurrency exchanges are feeding information into interconnected compliance databases. When you sell crypto on an exchange, that exchange has reporting obligations. That report doesn't wait for tax season. In many cases, it goes to federal databases in near real time. So by the time that $43,000 hits your checking account, a government system may already have a record of where it came from. The deposit doesn't trigger the investigation. The deposit confirms the picture that was already being assembled without your knowledge. The third layer is what happened in Germany, and you need to hear this even if you've never set foot in Europe. In 2025, German prosecutors successfully pursued criminal tax evasion charges, not civil penalties, criminal charges, against individuals who had undisclosed gains above €50,000, not 50 million, 50,000. People who genuinely believed they were operating in a gray area, who had been told by financial advisors that their structure was defensible, who never imagined they were looking at prison time. The court's position was simple and brutal. Ignorance of the law is not a defense. The law changed. You didn't adapt. That's on you. Now here's why these 3 facts connect directly to the man from the beginning of this story, the one with the frozen account and the letters from 2 different federal agencies landing in his mailbox. He didn't trip one wire. He tripped all 3 at once, without realizing any of them existed. And the reason he didn't know they existed is not because he wasn't paying attention. It's because the people who profit from his confusion, the banks charging compliance fees, the tax attorneys who get called after the crisis begins, the financial platforms that benefit from unclear rules, none of them had any incentive to explain the new machinery before he needed it. The system isn't evil. That's what makes it so hard to fight. Evil you can argue with. Evil has a face. This is just automated, indifferent, efficient, and it is running right now, quietly scoring every transaction you make, building a profile you've never seen, applying rules you've never read, and the only people who come out of it intact are the ones who understood the new rules before they needed them. Not after the letter arrived, before. So when I tell you that what's coming next in this story is the part that changes how you think about your own money, I mean that. Because we're about to go from the system to the people it has already caught. And the numbers are going to get very specific, very fast. And I want you to meet three people. I'm not going to use their real names, but I want you to understand that these are not hypothetical worst-case scenarios invented to scare you. These are the kinds of situations playing out right now, in real time, across this country and across the developed world. Different starting points, different mistakes, same destination. And at least one of these stories is going to feel uncomfortably familiar. The first person, call him David, is a 51-year-old logistics manager from Ohio. Solid career, modest savings, the kind of guy who reads the financial news on Sunday mornings and feels like he has a reasonable handle on things. In the spring of 2025, David bought $16,000 worth of Ethereum. Not because he was chasing moonshot returns, because three different people he respected told him it was a reasonable hedge against inflation, and the amount felt manageable, small enough that he figured it wouldn't attract serious attention. He held it for 14 months. The value climbed. He sold it in the summer of 2026 for just over $16,000 in profit, bringing his total proceeds to a little over $32,000. David had done some research. He knew there were reporting thresholds. He thought he was operating below the level that would trigger serious scrutiny. What David did not know, what almost nobody told him, is that his cryptocurrency exchange had already filed an automatic report with the IRS at the moment of sale. Not at tax season, not after a delay, at the moment of the transaction. Before the money even cleared into his bank account, a federal database had logged the gain, the date, the amount, and his personal identification. When David filed his taxes the following April and reported the gain, correctly, honestly, accurately, the IRS cross-referenced his filing against that existing report. There was a discrepancy in the cost basis calculation, a small one, $1,200. David had calculated his original purchase price slightly wrong because of a fee structure he hadn't fully understood. That $1,200 discrepancy triggered an automated mismatch flag. 6 weeks later, David received a notice of examination, not an audit in the dramatic sense, but a formal process that cost him 4 months of stress, $2,000 in accountant fees, and a recalculated tax bill with interest. All of it over a $1,200 math error on a $32,000 transaction he reported voluntarily and in good faith. The second person, call her Sandra, ran a small consulting business in Arizona. Smart, experienced. The kind of entrepreneur who always felt like she had a sophisticated understanding of how money worked. In 2024, Sandra hired a financial optimization specialist, someone who advertised himself as an expert in legal tax reduction strategies for self-employed professionals. He recommended a specific agency structure, a way of routing client payments through a business entity that would reduce Sandra's reported personal income while keeping the funds accessible. It wasn't underground. It wasn't offshore. It was the kind of arrangement that, 5 years earlier, existed in a genuinely gray area where aggressive but defensible interpretations of the tax code allowed for this kind of structuring. What Sandra didn't know, and what her advisor either didn't know or didn't disclose, is that by 2026, the IRS and the major financial institutions were no longer operating as separate systems with separate databases that only compared notes once a year at filing time. They were sharing data continuously, in real time, through a compliance framework that had been quietly expanded through regulatory updates in 2024 and 2025. Sandra's business account was flagged not because she did something overtly suspicious, but because the pattern of inflows and outflows, money coming in from clients, moving through the entity structure, then appearing in a personal account, matched a known profile in the AI compliance model. Her account was restricted under a provision designed to pause activity pending review. The restriction lasted 22 days. During those 22 days, Sandra missed payroll for her two part-time contractors, lost a client who couldn't complete a payment she couldn't receive, and spent approximately $6,800 on legal consultation fees. The optimization strategy her advisor had sold her as a money-saving tool ended up costing her more in 22 days than it had saved her in the previous 18 months. The third person, and this is the one that should genuinely unsettle you, call him Michael. Michael is a retired teacher from Pennsylvania, 62 years old, careful, conservative, the kind of man who keeps paper records of everything, who has never been late on a tax filing in his life, who considers himself deeply boring from a financial perspective because he has never done anything aggressive or creative with his money. Michael did not sell crypto. Michael did not use an optimization structure. Michael did not make any transaction that he or any reasonable person would describe as unusual. What Michael did was exist in the wrong database at the wrong time. In January of 2026, his name, date of birth, social security number, and financial account identifiers appeared in a data breach that originated from a financial services company he had used briefly in 2021 to consolidate some retirement account paperwork. He hadn't thought about that company in years, but his data was there, and when that breach was processed and cross-referenced by the fraud detection systems that banks are now required to run continuously, Michael's profile was elevated to what the industry calls enhanced monitoring status. He was never notified. There is no law requiring the bank to tell you that your risk classification has changed. He simply became, overnight, a customer whose transactions were being reviewed at a higher level of scrutiny. 3 months later, Michael received an inheritance from his mother's estate, $37,000, a completely legitimate transfer, fully documented from an attorney-managed estate account. It hit his account on a Tuesday. By Thursday, his account had been restricted pending review of the large inbound transfer. Michael had no idea that his profile had been flagged months earlier. He had no idea why a clearly documented inheritance was being treated as suspicious. The restriction lasted 11 days. Michael, a 62-year-old retired teacher who had never done a financially aggressive thing in his life, spent those 11 days convinced he had somehow, unknowingly, done something wrong. He hadn't. But that is almost the cruelest part of this story. The system didn't care whether he had done something wrong. The system saw a pattern that matched its criteria, and it acted. The fact that the underlying reason, a data breach from a company he barely remembered, was completely outside his control was irrelevant to the algorithm. The algorithm doesn't weigh intent. It doesn't weigh history. It weighs data. 3 people. 3 completely different entry points into the same trap. David was caught by a reporting system he didn't know existed before he filed. Sandra was caught by a regulatory framework that changed after she implemented a strategy that was legal when she started it. Michael was caught by a breach he didn't cause and a monitoring status he was never told about. And here is the single most important sentence in everything I've said so far. None of these 3 people were doing anything that felt risky at the time. That's the whole point. The trap doesn't feel like a trap when you step into it. It feels like a normal Tuesday. It feels like a smart financial decision. It feels like paperwork you already handled. The people who walked away clean, the ones who didn't get the letters, didn't get the frozen accounts, didn't spend their savings on legal fees, they weren't luckier, they weren't richer, they weren't smarter in some general sense. They simply knew, specifically and precisely, where the new lines were drawn. They knew which transactions triggered which reports. They knew how the AI scoring models inside banks were classifying asset liquidations. They knew that optimization strategies that were standard advice in 2022 could become liabilities by 2026. They had current information in a landscape where the rules were moving faster than the conventional financial media was reporting them. Because here is the truth about the gap between the people who got caught and the people who didn't. It was not a gap in effort or integrity or financial discipline. It was a gap in information, specific, current, operational information about how the machinery actually works right now, not how it worked 3 years ago, not how a generalist financial advisor remembered it from a continuing education course he took in 2023. The man from the beginning of this story, the one who sold his silver, took his wife to dinner, and started dreaming about Portugal, he had the right instincts. He had the right timeline. He had the patience and the discipline that most people never develop. He failed on one single point, at one specific moment, in one particular decision about how and when and through what structure to receive money he had legitimately earned. And that is the conversation we need to have next. Because the exit exists, but it is not where you've been told to look for it. So let's talk about the exit, because everything I've told you up to this point, the frozen accounts, the federal letters, the automated systems running in the background of every transaction you make, none of it is meant to paralyze you. It's meant to reorient you, because the solution to all of this is not to stop investing. It's not to stuff cash under a mattress. It's not to disappear from the financial system. That's not protection. That's surrender. And the people who benefit most from your confusion would love nothing more than for you to conclude that the whole thing is too complicated and just hand your money over to someone else to manage. The real exit is information, but not the kind of information you've been sold. Not the glossy newsletter with the smiling advisor on the cover. Not the YouTube channel telling you that one weird trick protects your wealth from the government. Real, specific, operational knowledge about how the system actually functions in 2026. And I'm going to give you 3 things right now that most financial advisors will not tell you. Not because they're hiding them maliciously, but because most of them are working from a mental model that is already 2 years out of date. The first thing you need to understand is this: silence is no longer neutral. There is a deeply ingrained belief among people who are trying to be careful with their finances that the best strategy is to stay quiet, stay small, and avoid drawing attention. Don't make big moves. Don't let the IRS see anything unusual. Keep your head down. That instinct made sense in a different era. In 2026, it can work directly against you. Here's why. The AI compliance systems that banks and federal agencies are now running do not just flag activity that looks suspicious. They also flag the absence of expected activity. If your account history shows a pattern of regular income and then suddenly receives a large one-time deposit with no corresponding documentation trail, no prior tax filings that reference the asset, no matching exchange reports, no audit paper trail, that gap itself becomes a red flag. The system interprets missing information as concealment, so the instinct to stay quiet, to not declare, to not document proactively, is now one of the fastest ways to end up in exactly the situation you were trying to avoid. Transparency, done correctly, is your single most powerful protective tool. Not hiding, documenting, proactively, before the question gets asked. The second thing, and this one will make some people uncomfortable, is that the optimization strategies you may have been sold in the last 3 to 5 years need to be reevaluated right now, not eventually. Now, the regulatory landscape that made certain agency structures, certain asset holding arrangements, certain income routing strategies, defensible or at least ambiguous, has fundamentally shifted. The IRS and major financial institutions are no longer operating with the kind of institutional separation that allowed gray areas to stay gray. They share data. They compare notes in real time. And the AI systems they use are specifically trained to recognize the structural fingerprints of tax optimization strategies. Not just the obviously illegal ones, but the ones that were marketed to you as perfectly legal aggressive planning. If you implemented something in 2021, 22, or 23 that was described to you as a smart structure for reducing your tax exposure, and you have not had a qualified professional review that structure against the current regulatory environment, you are carrying risk you may not be aware of. The cost of that review is a few $100s. The cost of finding out you needed it after a compliance flag has already been raised is measured in thousands, sometimes tens of thousands, and always in months of your life. The third thing is the one that sounds the most boring and has the highest practical value. Know your specific numbers. Not approximately, specifically. Know the exact transaction thresholds that trigger automatic reporting obligations for the types of assets you hold. Know how your specific exchange or brokerage handles IRS reporting, and know when that reporting happens, because in many cases, it happens at the moment of transaction, not at the end of the tax year. Know how a large one-time deposit will be interpreted by your bank's compliance model given your account history. Know what documentation you would need to produce if that deposit were questioned tomorrow. This is not paranoia. This is the financial equivalent of knowing your blood pressure numbers. It's the baseline information that lets you make decisions with your eyes open instead of finding out the hard way that you were operating on assumptions that no longer match reality. One conversation with the right professional, not a generalist, not someone selling you a product, but someone who specifically understands current compliance frameworks, is worth more than a year of financial podcast episodes about macro trends and asset allocation theory. None of these three things require you to become a tax attorney. None of them require you to overhaul your financial life. They require you to update your operating assumptions to match the system that actually exists in 2026, not the system that existed when you first started paying serious attention to your money. Now I want to go back to the man at the beginning of this story, the one who sold his silver, took his wife to dinner, started dreaming about Portugal. $43,000 in his account on a Thursday, and 8 days later, a frozen account and 2 letters from federal agencies sitting on his kitchen table. Here's what he did wrong. Not morally, not criminally, procedurally, he sold a significant asset, an asset that had been held outside of traditional brokerage reporting infrastructure, and he deposited the full proceeds into a personal checking account in a single transaction, without first establishing a documentation trail that matched the deposit to its origin. His bank had no prior context for where that money came from. His tax history showed no prior reported asset of that value. And the amount, $43,000, landed almost exactly in the range that AI compliance models are specifically calibrated to scrutinize, because it sits above common structuring thresholds but below the amounts that typically come with automatic attorney involvement. One step. That's all it would have taken to change the outcome. Not a different decision about whether to sell, not a different asset, not a different bank. One step taken before the transaction. A letter from his precious metals dealer documenting the sale, submitted proactively to his bank's compliance department with a brief written explanation of the source of the funds. In the industry, this is called proactive source of funds documentation. It takes about 45 minutes to prepare. It costs nothing. And when a bank's compliance system generates a flag on an incoming deposit and a human reviewer pulls the file, the presence of that documentation changes the entire trajectory of the review. The flag doesn't disappear, but it gets resolved in days, not weeks, without a letter, without a frozen account, without a retirement benefits recalculation. 45 minutes. That's the gap between his Thursday celebration and his Tuesday nightmare. Not intelligence, not wealth, not access to secret information that only rich people know. 45 minutes and the specific knowledge that proactive documentation exists as a tool and that this particular transaction at this particular amount warranted using it. Portugal is still on the table for him. Probably, the process will resolve. He'll likely be fine in the end, but he will spend the next several months wondering if he's fine, paying people to help him prove that he's fine, and carrying a low-grade financial anxiety that will color every future decision he makes with money. Not because he did anything wrong, but because he didn't know about one specific procedural step that the people who designed the system never bothered to explain. You now know about it, and that is the entire difference between the people the system catches and the people who walk through it cleanly. Not luck, not wealth, not connections, information, current, specific, operational information about how the machinery actually works, and the willingness to act on it before the letters arrive, not after. The system is not going to slow down. The automation is not going to roll back. The data sharing is not going to become less comprehensive. But you are not helpless inside it. You never were. You just needed someone to show you where the walls actually are. Now you know,